When the market's shock absorber breaks. For more than 40 years, there was a rule so reliable that it almost felt like a law of nature. Whenever fear entered the system, whenever growth slowed, whenever markets panicked, U.S. government bonds would rise. Stocks could crash, credit could freeze, risk could evaporate. But the bond market, especially the U.S. 10-year Treasury, would step in like a silent guardian. Prices would go up, yields would fall, portfolios would stabilize. This was not just diversification, it was insurance. The bond market was the shock absorber of global finance, and for decades it worked, until it didn't. The end of the bond backstop. Something fundamental has changed. Today, we live in a market where bond yields can rise even when the economy looks fragile, where fear no longer guarantees safety, where selling pressure hits both stocks and bonds at the same time. The old relationship is breaking down. The instrument designed to protect the system is now amplifying its stress. And at the center of this shift stands one number that matters more than almost anything else: the U.S. 10-year Treasury yield. Why the 10-year matters? The 10-year yield is not just another interest rate. It is the reference price of money for the entire world. It influences mortgage rates, corporate borrowing costs, equity valuations, currency flows, government debt sustainability. If the financial system were a body, the U.S. 10Y would be its pulse. And right now, that pulse is behaving in ways we haven't seen in generations. The golden era, 1980 to 2020. To understand what's happening, we need to go back. From the early 1980s until around 2020, the global economy lived through a disinflationary supercycle. Inflation trended downward for 40 decades. Why? Globalization pushed labor costs lower. China became the world's factory. Supply chains became longer, cheaper, and more efficient. Demographics were favorable. Debt was manageable because interest rates kept falling. In that world, bond yields had a natural bias downward. Whenever trouble appeared, yields fell even more. That's why bonds worked so well as protection. That's why the 60-40 portfolio became gospel. That's why investors learned to trust duration. The system was stable because inflation was dead, or so we thought. The post-2020 break. Then came the rupture. Pandemics, supply chain shocks, energy crises, geopolitical fragmentation, trade wars, sanctions, reshoring, defense spending, fiscal expansion on a scale previously unthinkable, and perhaps most importantly, permanent budget deficits. Not cyclical, not temporary, structural. Governments stopped pretending they would ever truly balance the books. The result? A world where inflation is no longer an accident, but a feature. And in that world, bond yields no longer fall by default. The real driver, term premium. Here's the critical point most people miss. Rising yields today are not primarily about strong growth. They are not about booming productivity. They are not about an overheating economy. They are about risk, specifically term premium. The extra compensation investors demand for holding long-term government debt. And that premium is rising fast. Why? 1. Massive bond supply. The U.S. government is issuing debt at historic levels. Deficits are large, refinancing needs are constant, maturity walls are growing. The market is being flooded with treasuries, and basic economics still applies. When supply overwhelms demand, prices fall, yields rise. Reason 2. Foreign demand is fading. For decades, foreign buyers, central banks, sovereign wealth funds, export-driven economies absorbed U.S. debt. That support is weakening. Reserve diversification, geopolitical distrust, weaponization of finance, domestic needs elsewhere. Foreign demand is no longer guaranteed, And when marginal buyers disappear, yields must rise to attract new ones. Reason 3, credibility risk. This is the most dangerous factor of all. Markets are beginning to question not whether the US can pay, but how it will choose to pay, through inflation, financial repression, currency debasement. The market is not pricing growth, it is pricing credibility risk. And credibility, once lost, is expensive to rebuild. When bonds stop protecting. This leads to the most profound consequence. Bonds are losing their defensive character. When equities fall, bonds are no longer guaranteed to rise. Correlation is changing. That single shift forces a complete rethink of portfolio construction. The old playbook no longer works. What replaces bonds? If bonds no longer hedge risk, something else must, and the markets are already signaling the answer. Gold regains its role as a monetary hedge. Commodities protect against structural inflation. Real assets matter again. Not because they generate yield, but because they protect purchasing power. This is a world where duration is danger. The longer the maturity, the greater the risk. The policymaker's trap. Central banks are stuck. If yields rise too much, financial conditions tighten violently. If they intervene too aggressively, credibility erodes. If inflation returns, trust disappears. There is no painless path. Every choice carries a cost, and that cost is being transferred to investors. The one signal that matters. So what should you watch? Not stocks, not headlines, not narratives. Watch the US 10-year yield. But don't ask how high it goes. Ask one question only. Does it still fall when panic arrives? If the next crisis hits and yields remain elevated, then the conclusion is unavoidable. The financial structure has changed permanently. Government bonds are no longer a safe haven. They are just another risk asset with consequences far bigger than most are prepared for. Closing. For 40 years, the market had a safety net. It trusted the bond market to catch it when it fell. Today, that net is fraying, and in some places, it may already be gone. The era of active protection is over. The era of structural risk has begun. And the US 10-year Treasury is telling that story, whether we're ready to hear it or not. Looking ahead, 3 possible futures for the US 10-year. History never moves in straight lines. It moves through regimes. And when a regime changes, the future doesn't arrive as a single outcome. It arrives as a set of paths, each defined by a different trade-off. For the US 10-year, there are 3 realistic futures. None of them are comfortable. Scenario 1, the return of control. In this future, policymakers refuse to let yields spiral. The government cannot afford them, the system cannot survive, and the political cost is simply too high. So intervention begins, not loudly, not officially, but persistently. The central bank steps in as a buyer of last resort. Balance sheets expand again, liquidity quietly returns. Yields stop rising, but something else begins to fall instead. The purchasing power of money. This is not default, it is stealth taxation through inflation. Bondholders get paid, but in weaker dollars. In this world, nominal stability masks real erosion. Financial repression becomes policy. Savers lose slowly but predictably. It looks calm on the surface, but beneath it lies a permanent transfer of wealth. Scenario 2, the market takes over. In the second future, policymakers hesitate. They talk, they debate, they delay, and the bond market decides for them. Yields rise further, not because of growth, but because trust continues to drain away. Every auction needs a higher price. Every maturity demands more compensation. Debt service costs explode. Fiscal math breaks down. Risk assets struggle. Volatility becomes constant. This is not a crash, it's worse. It's a slow-motion repricing of everything. In this world, long-duration assets suffer. Equity multiples compress. Housing feels the pressure. Governments lose flexibility. Nothing collapses overnight, but nothing feels safe either. The real crisis test. The third future is the most revealing. A real crisis arrives. Not inflation data, not GDP prints, but genuine panic. A credit event, a geopolitical shock, a systemic failure. And the question is finally answered. Does the US 10-year still rally? If yields fall sharply, the old system, though damaged, survives. But if yields stay high, or worse, rise further, then the verdict is clear. The bond market has lost its role as a refuge. At that moment, the global financial order crosses a line, because a world